The August 11th trading session has ended, and the market is closing with a distinct sense of unease. Equities have staged a significant V-shaped recovery off the early August lows, with capital aggressively buying the dip over the past week. Yet right at the local highs, that buying momentum has stalled. This is a one-hour chart of the S&P 500. Heading into the final bell, price action drifted lower into a weak close, settling at 7,728.20. Before we analyze this structure, note that this is an educational framework. It is not financial advice to buy or sell. Trading involves significant risk. Stalling at these local highs suggests a shift in participation, a pause that indicates market participants are reassessing risk. This hesitation is driven by the macroeconomic calendar. Tomorrow morning brings high-impact data that will likely dictate the next major market swing. The economic calendar reveals what the market is waiting for: the USD Core CPI month-over-month print, scheduled for 8:30 a.m. on Wednesday, August 12th. The red folder markers classify these as maximum impact events, known for creating rapid price expansion and high-frequency trading activity. The Consumer Price Index measures inflation, a metric that directly influences Federal Reserve interest rate policy. Those policy expectations, in turn, drive the valuation of every equity on the board. We will deconstruct today's closing data across breadth, price action, and volume to build a strict, risk-managed if-then trading plan for tomorrow's reaction. Guessing market direction before a CPI print is gambling. Professional edge relies on structural preparation and disciplined reaction to the data. To understand this defensive posture, we must look past the calendar and examine market breadth at the time of the close. This S&P 500 heat map shows exactly where capital is flowing. We see a fractured market with a broad mix of red and green. However, localized distribution is occurring in mega-cap tech. Communication services is struggling, led by Google's drop, extending to Amazon and Tesla. When trillion-dollar companies experience this level of targeted selling, it indicates institutional capital is actively reducing exposure ahead of the news. This is a deliberate rotation rather than a broad panic. Healthcare, led by Eli Lilly and United Health and other defensive sectors, are seeing pockets of strength. Capital is moving out of high-beta risk assets and into defensive safety, confirming a cautious posture ahead of the CPI data. We can track how this heat map weakness translates to the charts by isolating the tech sector's price action. The one-hour timeframe serves as our lens here, as it filters out minor intraday noise while highlighting pre-news structural shifts. On the one-hour chart of the NASDAQ 100, the price action following the initial gap up has devolved into a choppy, directionless range. Over the past 4 trading sessions, a pattern of declining peaks has emerged. Technically, these lower highs indicate that supply is meeting demand at progressively lower price points. The session ended with a cluster of red candles right near the immediate lows at 29,525. With the primary engine of the recovery, tech, stalling, a broader market push lacks the structural support to continue higher without a significant catalyst. We need to determine if this exhaustion is limited to tech or if it is appearing across other major indices. The one-hour chart of the Dow Jones Industrial Average provides a read on traditional, non-tech economic sentiment. The Dow is exhibiting nearly identical behavior: a downward drift, a sequence of lower highs, and a weak close at 53,790. We find final confirmation on the S&P 500 one-hour chart. While price shows us the result, volume profiling validates the intent by revealing whether a drop is due to a lack of buyers or active selling. During the S&P 500's recent downward drift, the histogram shows steady, elevated volume bars. Consistent, active volume during a price decline suggests institutions are deliberately de-risking and distributing shares. The uniform price compression and active volume across all 3 indices indicate a broad, systematic hedging of risk ahead of tomorrow's news. We have established the institutional footprint. Now we translate that into an execution strategy for tomorrow morning. The priority when trading high-impact events like CPI is absolute capital preservation. Front-running the print is high risk. Pre-market liquidity thins, slippage increases, and algorithms often hunt liquidity in both directions the moment the data is released. Our objective is to wait for the data to trigger institutional capital flows and then react to the established direction. Holding cash into a binary event is an active defensive decision. In scenario A, we consider the reaction to a hot inflationary CPI print. On the S&P 500 chart, we identify the consolidation base near 7,700 as a critical level. If inflation exceeds expectations, Treasury yields typically spike, and risk assets often sell off as rate cut hopes diminish. The technical trigger for a short position requires a 15-minute candle to close fully below today's lows. Because of the rapid ascent last week, breaking this support opens the door to a liquidity void. These serve as our immediate downside targets. A hot print would align with the technical weakness identified at the close, accelerating the current distribution into a clear downward trend. Scenario B assumes a cool, disinflationary CPI print that the market views favorably. Removing the macro overhang clears the way for a rapid unwinding of short positions and a surge of sideline capital. On the S&P 500, bulls must conquer the recent lower high trendline apex near 7,760 to prove the rally has resumed. The bullish entry trigger requires letting the initial 8:30 a.m. shockwave settle, buying only on a confirmed volume break above 7,760. We look to trade the structural trend that emerges when volume enters the market at the 9:30 a.m. New York Open, ignoring the pre-market noise. Technical charts provide the structural map, while macro data provides the catalyst. Professional edge lies in waiting for the alignment of both. Protect your capital and wait for your trigger.